Hello, everyone. A very good evening to you all. Welcome to the second edition of Quantum Mutual Fund's E-Path to Profit. I am Ghazal Jain and I will be the moderator for this session. On the agenda today is a discussion on COVID-19's impact on business and macroeconomy, as well as the portfolio positioning and performance of the Quantum Long-Term Equity Value Fund, an honest analysis of the past and what the future holds. But a few instructions before we begin. All attendees have been muted for the smooth functioning of the session. Audio of the speakers and myself has been enabled. But if you do have any questions for the speakers through the session, please send them across to us using the chat option on the lower half of your screen. And we'll try to take as many questions as time permits at the end of the session. So it's time now to meet our first speaker. Mr. Ajit Dayal, founder, Quantum Advisors, which is the sponsor and parent of Quantum Mutual Fund, will be addressing us first with an overview of the current economic landscape. He will be throwing light on the government's response to the pandemic and also run us through his personal asset allocation, specifically his equity strategy. So over to you, Ajit.
Thank you, Ghazal. Hi, everyone. Good to see you, I guess, in this zoomed up world. We started Path to Profits in 2009, so it's been a long, long time. And this is our first E-Path to Profit that we're having for the Quantum Long-Term Equity Fund. We had an E-Path to Profit last week just talking about the debt funds and what was happening in the market space on that. So the way it will be is basically I'll be talking a bit on the macro, then Atul, as a fund manager, will talk about what Quantum Long-Term Equity Value Fund does, and then Subbu will take it from there and explain to you all why we think, why we've not performed well. We know we haven't performed well, trying to understand what's happening, and we'll run through that. So if I can just, start with the disclaimer in terms of where we are. So I am the founder of Equity Master, Personal FN, and Quantum Advisor, which is the sponsor of Quantum Mutual Fund. And clearly they've been all very different companies from what you see in the field of finance. If I look at India's long-term, economy, in terms of the next slide, Kashif, please. If I look at India's long-term economy, which is that's the one. So if you look over the last 40 years from 1980, so this is effectively government number 11. We've got the same government in 2 terms. The average rate of GDP growth has been 6.3% per annum. And what we have seen is that the last few years, the GDP growth rates actually slipped, and the next slide clearly shows that. So the next slide, Kashif, the next slide indicates that what you see in the red is under the changed GDP statistics, the way they calculated, which started really in 2015. And everyone kind of assumes that from the numbers that are declared, you need to deduct between 1.5 to 2 to 2.5%. So when the government reports a 5% rate of growth in GDP, to equate it to what's outside the red circle, you need to remove about 2% from there. So it's actually 3%. So as I indicate in the next slide again, we already had a weakened economy. And if you turn to the next slide, Kashu, please, you'll be able to see that, the discussion that India was early in response to COVID is a myth. The numbers don't show that up. The dates don't show that up. COVID was first, the first alert was from China in December 2019 to the WHO. The first international person to get COVID outside of China was basically, as the dates indicate, January 13. And then India only responded much later. And the response from India was good, but it was quite late. So yes, we did respond, but it wasn't an early response. And in the next slide, we just talk about the impact on the economy. So if you look at what's happened is, really, in terms of GDP growth rates, again, when they made the decision, there was no discussion with the states. That's getting more and more obvious. That was just a few people who decided it and kind of left the country loose in some sense. The impact on the GDP will be extremely negative in our view. And we think that depending on how the government responds, we know the Prime Minister speaking today at 8 p.m., so he follows us in some sense. And we'll have to see what he says then. But there's a lot of risk that you will have companies that are in trouble. Less than 5% of companies literally have cash to last more than 6 months. And that's assuming that they do not pay off any interest and they don't pay the banks, but you just pay salaries and they pay the running cost of the wages. And on the next slide, we've got the government, again, we'll see what happens today from 8 p.m. onwards. But generally speaking, the government has been quite clueless. They don't know what they're doing. They don't know what to do. And look at the impact on India. Every day, we're losing about 30,000 crores of GDP. So if you assume that this goes on for a few months, as we have assumed, you can see that the loss of GDP due to the lockdown, if you assume it goes on for about 60 days, will be $240 billion, or about 8% of India's GDP. Now, when you're losing 8% and you're trying to give a rescue package, that rescue package is 0.8%. It doesn't make any sense. If you're losing 8%, you have to give a rescue package of at least 8%, if not more, to get animal spirits back. So I think the government's been really, really slow on this. Let's talk a bit about the markets on the next slide. So if you look at the PE ratio of the market, yes, it's fallen. And a lot of people are going on TV and saying, this is terrible, this is bad. But compare it to SARS. In 2003, we had the first global pandemic. And look at the PE ratio when SARS hit India. Look at the PE ratio when Lehman hit the world. And the markets really haven't fallen relatively that much. So on 23rd March, when the markets fell to the 25,000 levels, that would have been closer to the PE ratios that we've seen at the time of Lehman and SARS. And the next slide again just indicates that from the time, from September 2013, when you had the fragile five, when the US was raising interest rates, India went to a bit of a spin, and then Prime Minister Modi got elected in May 2014. We had demonetization in November 2016. We had GST in July 2017, and then of course we've had with us we've had the ILFS breakdown, in September 2018, and now we have COVID. So if you look at the index in dollar terms, the lowest line, that's a dollar index. And if you were to eyeball it, it's pretty much back to where we were in 2014-ish or so. So if the markets correct further, then you could say, okay, we are back to the valuations of SARS and Lehman, and they look fabulously cheap. They don't look that cheap now, but they're still attractive. In terms of what an investor should do on the next slide, so Quantum was not trying to create one fund. What we said is, let's create a platform which can give you an allocation solution between your debt, between your gold, and between equity. So in equity, what we did is we built a Quantum Long-Term Equity Value Fund. That's our style of investing. And we also built the Quantum Equity Fund of Funds. The Quantum Equity Fund of Funds is very unique. We look at other fund managers and we see what funds they manage and what funds we like, and we built that in a basket. And we've always recommended it for those who've attended Paths to Profits. We've always recommended a 20% weighting in the Quantum Long-Term Value Fund and an 80% weighting in the Quantum Equity Fund of Funds. That's always been our desire. And let's see, if you had done that basket, what would it look like? So the next slide, we have 4 graphs here. We have, if you will, the graph, we've got the long-term equity fund, which was doing extremely well till very recently. And then the red line is the Quantum Equity Fund of Funds, which is a basket of 6, 7, 8 funds that we managed by other fund managers. And then you've got the BSE 200 and the BSE 30. So that's what it's been since July 2009. That's when the Quantum Equity Fund of Fund was launched. As you all know, as the early investors, the Quantum Long-Term Value Fund was launched in March 2006. So 3 years later, we came up with the Equity Fund of Funds. And on the next slide, again, I'll just show you the return numbers, and Subbu will talk about this later as to what went wrong. But if you look at the 1-year numbers for the Quantum Long-Term Equity Value Fund at minus 23.6%, it is much worse off than the index on the right. And it's also, it's much worse off than the Quantum Equity Fund of Funds on the left. But if you had a blend of 80-20, look at the numbers on the right. An 80-20 number would have actually masked the performance, the recent performance that's happened in the Quantum Value Fund if you had taken the 80-20 basket. So what should investors do now? And in the next slide, I indicate that given where we are in the markets, next slide, please, where we are in the markets. So SARS ended, as I said, in June 2003. The COVID, the rules may end, but it's a bit, the virus may be kind of behind us, but the rules and the stupidity of government in terms of trying to get the economy moving up, that's a question mark. We don't know. So March 2021 will definitely be a write-off for the economy. By March 2002, we should have a natural recovery, unless this government does something unknown like a demonetization again and gives us another bazooka or torpedo. We're not sure. For the next 6 months, very difficult to say what the market's going to do. If you saw the earlier valuation charts, if there's more panic in the world, if there's more fear, and if the government does not do enough, then the markets could fall by 20% or so. But on a 2-year basis, our view is that just to get back to the index peak of January 14th, 2020, that means there's a 30% upside from where we are today. So that's attractive to get a 30% rate of return on a 2-year view, assuming that GDP recovers. That would be pretty good. So if you were an SIP investor, I would say yes, you can keep on adding and you can keep on doing stuff. That's very, very useful. Sorry, I apologize for that. That was my alarm to keep quiet. So if you keep on adding with the SIP, that makes sense because it's very difficult to time where we are. On the next slide, I did mention, next slide is talking about allocation. I think one of the key lessons for me as an individual living through SARS and living through Lehman was to ensure that I keep some money aside. And in every honest truth, I put this at the bottom of the honest truth in the table. And the table says that how much money am I spending every month? So let's assume I spend, for argument's sake, 1 lakh rupees a month. I keep aside, for me, I keep aside 24 lakhs aside in a safe place. Like I know it'll never be in trouble. So I put 3 months of money into a savings bank account, so it's easy to get. And I put the rest of the money in the quantum liquid fund. And after that, after whatever's left, then I put 80% in equity and 20% in gold. And within equity, because I'm a value guy, I prefer value investing to other styles of investing, and I'm willing to live with underperformance. But as a value person, I put more of my equity in the quantum long-term equity value fund. And I put less of my money in the quantum equity fund of funds. But we always advise individuals who are not value investors and who generally want to see a market appreciation, flip your allocation. You should put 80% in quantum equity fund of funds and 20% in quantum value fund, of that 80% basket in equity. And the other 20% you put in gold. If you do this, you've got a bulletproof portfolio. Because just try to think about it, even if you have a 12-month time horizon, right? Right now, many people are sitting at home. They're not sure whether their businesses will open, whether they'll have an income. They're not sure if they'll have a job to go back to. They're not sure if they'll get a higher increase in salary or not. No one's sure about anything. So given that, if you had 12 months of money kept aside to look after 12 months of expenditures, you'll be very, very comfortable and you can focus on looking after your family and your friends rather than worrying about, do I have enough money to survive till this pain gets over? So that's what I've done with my portfolio. I've kept it in a very sort of sensible, safe way. I'm myself disappointed because I've got a bigger chunk of my equity portfolio in quantum long-term equity value fund, and we know it's not performed, and that's why we are here in front of you this evening. So with that, I'll hand it over back to Ghazal. Thank you.
Thank you, Ajit. Thank you for sharing with us that the Indian government's response to the coronavirus outbreak has been grossly inadequate and delayed. And this makes the Indian economy further vulnerable, considering that it was laden with weaknesses even before the crisis hit us. Also, thank you for sharing the 80-20 blended equity allocation strategy through the Quantum Equity Fund of Fund and the Quantum Long-Term Equity Value Fund, where one can invest in a basket of equity funds to prevent style bias and get diversified across 6 to 8 mutual fund houses. And lastly, whether it is this crisis or the next, we can all learn from Ajit's personal asset allocation. Step 1, keep 20% of your money safe in liquid funds and bank deposits. Step 2, diversify the remaining 80% into equities and gold for long-term wealth creation. So thank you, Ajit. Moving on. COVID-19 has disrupted not only our lives, but also the economy, and businesses, big and small, are finding it extremely challenging to operate and realign their business models to face emerging ground realities. Our next speaker, Mr. Atul Kumar, Head Equity Funds, Quantum Mutual Fund, and Fund Manager, Quantum Long-Term Equity Value Fund, will take us through the investment philosophy and portfolio construction process of the Quantum Long-Term Equity Value Fund in these unprecedented times. So over to you, Atul.
Yeah, hi. Good evening to everybody. And thanks, Ghazal, and thanks, Ajit, for setting the context. Uh, as I understand, as for many of you, for us as well, this is the first time we are, instead of having a meeting in a room with maybe 50 or 100 of you, but sitting here in isolated rooms and talking to you. So that is a little nervous experience, but I will try to take you through our quantum long-term equity value fund. On slide number 17, we have the value fund. By definition, as a value manager, we are trying to buy stocks which are relatively inexpensive as compared to the markets overall, and as compared to the category or the stock itself. The distinction between a value fund and a growth fund is that a growth fund that concentrates on the denominator of PE, which is E or the earnings, and they look at stocks which have a higher earnings growth. Whereas a value fund that is much more looking at paying a lower price and its focus is on the numerator by buying stocks which are relatively on the cheaper side. We go to the next slide, which is slide number 18 of the presentation, and how we are looking at in terms of our internal process. So we at Quantum, we are looking at four parameters, macro parameters, and we are looking at them from the same pair of eyes, which is long-term GDP, inflation, 10-year GSEC yields, and finally on the Forex rates. So our long-term GDP assumption is in the range of 6.5 to about 7% kind of a range. And in the near term, obviously, it is much, much lower at 0.2%. And probably given the uncertainty in the economy, even that's a kind of a moving number per se. The reason why we look at the same pair of eyes, these GDP estimates, is so that if there is an analyst who's tracking cement, and if she is looking at cement consumption at 1.4 times growth for cement consumption to GDP, and an auto analyst, if he or she is tracking auto stocks, that multiple also, for example, historically, if auto as a sector has grown 1.4 or 1.5 times that GDP, probably they also look at from the same pair of eyes. Historically, we have seen that having those long-term numbers makes a lot of difference because, for example, during crisis years, at the time of Lehman, in the short term, the PE, the GDP numbers had fallen and the stocks had fallen a lot, but we could see that the long term the numbers are the same. They remain on the higher side and they give a lot of opportunities to buy or sell on the stocks. I move to the next slide, which is on slide number 19, how we are looking at buying and selling of the stocks. The number one step there is we are looking at the demand supply scenario of an industry, how it is panning out. We are looking to meeting those companies, evaluating their managements, etc. At the second step is we are looking at the valuation parameters for many of these companies, which is analyzing by PE and other kind of measures, depending on sector to sector, they could vary. When we are buying stock, we make sure that we are buying a stock which is at least at a 40% discount to its fair value. That is the point when we enter the stock, and we sell the stock largely when our price target that we had set for the stock that is met. But there can be other factors as well when we are selling the stock. For example, there could be a changed view of the management of the business, or also because the upsides of the portfolio, they become more limited. I move to the next slide, which is on slide number 20. The stock picking at Quantum is bottoms up, a lot of it process driven, all of it process driven. When we are starting, the funnel starts at 327 stocks, as you can see at the bottom. these are all the stocks which meet our $1 million value criteria. That is, they trade $1 million a day. And from there, we have about 201 stocks. These are the stocks which we track. So the difference from 300 plus to 200 comes because some businesses could be very, very duplicate. For example, let us say there were historically a lot of PSU banks. They can come from, there could be lack of management access, or some of the businesses are opaque. So we are not able to track those kind of stocks. And from those 200 stocks, we go to building our portfolio, which is anywhere between 25 to 40 stocks. And they could form into the three large buckets, which is on the export side, on the infrastructure side, or on the consumption side. We move to the next slide, which is on slide number 21. And that broadly talks about how do we construct the portfolio for you. So the starting step is that the stock should have $1 million volume criteria, as explained in the previous slide. The reason why we would like to have a stock to have at least $1 million daily, because these stocks become very, very difficult to manipulate. From there is whether the stock is a part of BSE 30. We are not indexers, and we are very, very agnostic that whether it's a part of BSE 30. The next step, the stock has to be below buy limit. So only when there is a reasonable discount, which has been set at around 40%, only when we get the stock at that kind of a price is when we are entering into that stock. What sector it belongs to, we are totally agnostic to that, because it's a bottoms up. What comes from our research in terms of the sectors which are stocks belonging to sectors which would have a relatively good in terms of valuation is what we would buy. And from there we come to about 25 to 40 stocks. We would have minimum 2% weight uh, in terms of cost, maximum 6%. And we could allow the stock to go up to 10% before which we start to trim at it. The reason why we would allocate a 2% weight or a 6% weight or in between weight to a stock would depend on a number of factors, which includes what is the quality of earnings, how stable the earnings are, what kind of confidence do we have with the management, and then also what are the upside potentials, because as the upside potentials would decline in a stock, we would start to sell that particular stock. Coming on to on slide number 22 of the presentation. So on slide number 22, because we have followed a disciplined approach and we give you a portfolio which is relatively less risky and also performs on the upside side. So we are buying into businesses which have true fundamental value, and they are not necessarily just driven by the flows which are coming. We are buying stocks which are liquid, and the NAVs that you get they are tradable NAVs, not fake NAVs. Similarly, we are buying stocks which are which have their valuations or their businesses which are much more transparent, and we are able to understand. And that is how we could avoid a number of stocks which could have been traps for us. And finally, we are not taking into just the popular index stocks, which may not necessarily be value stocks. I move to page number 23 of the presentation. And there again, we are talking about the cash levels. The philosophy of the fund remains that if we are finding good value in the markets in stocks, we are invested in that. But if there is not good value, stocks are very expensive, then we sell and we are raising the cash levels. As you can see from the bottom part, where there is a vertical chart, and you can see that probably, you will have to maybe strain your eyes, but from May 14 onwards, there were some big towers. And that was the period when the government in 2014, Modi government got elected. Many of us, that includes me as well, believe that our economy is going to grow at 10% indefinitely. And when we started to meet companies, we could see that that's not happening. And that was the time when we could see that probably the stocks are looking very, very overheated. And that is the point, for example, where we were raising cash. So we could give some kind of protection to our portfolio. And also the upper part of it that shows at what kind of valuations the Sensex is trading at. And from there, as you can see that probably when the towers of us are formed, that is also coincided with very, very high valuation. And then the moment there is a correction, that is also a time when we are deploying our cash levels. And you can see that at various points of time, our cash levels are coming down just as the markets or the overall valuations are moving down. So that is what we have been using to make sure that there is an adequate protection on the portfolio. I move on to the next slide, which is on slide number 24. And here we are talking about how, as an investor, you should expect quantum to perform across market cycles. Uh, in most of the market cycles, whether it's a bear market, an uptrending market, a downtrending market, a volatile market, or the first leg of the bull market, those are the periods where quantum should kind of outperform. The first leg of the bull market also quantum should outperform. But in the latter, when the valuations become extremely frothy, it's all driven by speculation. That is the time when quantum starts to underperform. When the markets are bare, we outperform because our stocks are value, they are relatively inexpensive, and low valuation should hold. Similarly, when the markets start to rise in the first leg, we should also do well because our stocks are quality led. Uh, that's how one should look at. I go to page number 25 of the presentation. And on page number 25, again, we are talking about the performance. Uh, our performance in the 10 years looks good, but below that, less than 10 years, our performance has not been good. And a large part of that has to do with our 1 year performance. As you can see that in 1 year performance versus a return of minus 14.55, we had a return of minus 23.61, which is a underperformance of 9 percentage points or 900 basis points. If you look at it from the inception of the fund, that is from 2006 to 2020, in that period, in that 14 years, the annual underperformance comes to about 65 basis points. So our 1 year return has cost us, dragged our performance for the 3, 5, and 7 years, because that number has been so huge that it has dragged the overall numbers for us. On page number 26 is a kind of a disclosure in terms of the SEBI regulations, which is required. And with that, I come to the end and I hand it back to the moderator.
Thank you, Atul. Thank you for reiterating that Quantum Long-Term Equity Value Fund has stayed true to its mandate of value investing. The fund has followed discipline across market cycles, reducing risk and moving to cash when there was no value to be found. Now, even though the fund manager has assured us that the fund continues to invest in reliable and quality managements and businesses, which it thinks will not only survive in this downturn, but also thrive, the investors are still concerned about the disappointing performance of the fund in 2019. So our final speaker, Mr. Ivy Subramaniam, CEO and CIO of Quantum Advisors and board member of Quantum Mutual Fund, will throw some light on Quantum Long-Term Equity Value Fund's underperformance in 2019, and also why value investing as a strategy has not been working recently. So over to you, Subbu.
Thank you, Ghazal. Thank you, Atul, Ajit, for setting the tone for my talk. So very briefly, let me cover as to why has the performance slipped, particularly in 2019. So to give you a context, if you look back, what was the expectation and how did the earnings pan out? So going back after Modi won the elections in 2014, the expectation was very high. There would be reforms and earnings growth would be rapid. And each year we can see the consensus estimates of analysts, which Bloomberg tracks, beginning the year very aggressively at a very high EPS number, therefore a very high EPS growth. And then as the year goes by, as quarterly numbers are declared, these numbers get readjusted. And if you really see from 2014 to 2019, or even from 2016 to 2019, there has hardly been any EPS growth from a Sensex point of view. Of course, there would be individual companies where the growth rate could be high, but from a Sensex overall point of view, the earnings were very tepid. Go on to the next slide, please. So in this environment, when the earnings growth were very flattish, you had a huge expectation from the local Indians who continued to pour money into the equity mutual funds right from 2014 onwards. And the amount which came in was more than what we had collected over the past 11 years, what the mutual fund industry had collected over the past 11 years. It came in literally after 2014 from all the retail investors in India. Going on to the next slide, even the foreigners were very bullish. If you look at the FPI flow from 2014, as you can see, it began with $16 billion in 2014. And then most of the years they have been positive except in 2018. So collectively, if you look at the total activity, both from mutual fund as well as from FPI, the flow of money into Indian markets were very high, all based on the expectation that the earnings growth would be solid, that reforms would bring in a breakthrough in our economy, and that should reflect in higher earnings growth. But that was not the case, as you saw in the EPS numbers. Go to the next slide, please. So all that flow of money into the Indian markets with no earnings growth, what it resulted was in an expanded PE ratio. As you can see over here, the PE ratio went up to as high as 30 times, and then of course now it has corrected. But that was the main environment in which we were operating, where value stocks, which are typically lower PE ratios, but has a decent earnings growth, was very few and far between. We could not really get hold of many value stocks. And even over here, I want to comment that, while value stocks we were not able to get, the growth stocks itself did not deliver the kind of growth which the market expected. So the P ratio was really ripe for some correction. And COVID was one instance which allowed that to be corrected. But there was always the risk that if there is no EPS growth, and if there is only price growth coming in from inflow of money, that is bound to correct even even if there is a small amount of risk which comes through, and that is what happened when COVID came up. Please go on to the next slide. So I wanted to analyze, what happened. Why did we underperform in 2019? But to give you a context, I also wanted to look back over different periods, like as Atul had suggested in his, as he had shown in his PowerPoint. There are market instances, market situations where we will outperform. In some cases, we will be in line, but there will also be cases where we will underperform. So I really wanted to look at the events which shape the markets. Markets, as you know, need not move in line with the annual calendar year 2017, 18 or 19, but there are events which shape the market movements. So going back from 2015 to November 2016, when demonetization was announced, we were expected to outperform because it was generally a bullish market, and we did. We had good stock selection and we outperformed. Post demonetization from 8 November 2016, the next event was a year and a half later. That was the capital gains tax in budget 2018. It was an unusual bull market. Unusual because the earnings were still not coming through, not visible. The markets were up by 32%, and we were holding stocks which had hit our sell limit. We sold, we raised cash, and that was the reason we underperformed, as a value manager should. In an extremely bullish market, a value manager should underperform, and I think that is what happened in our case from 2016 to Feb 2018. Going on to the next slide. From Feb 2018, go to the next slide. From February 2018 to the, no, just go back one slide, please. Yes. Yeah. So post budget, the next big event was the ILFS crisis. So from Feb 2018 to ILFS crisis, the markets were up. This was a situation where we should normally outperform, but we underperformed. And this was due to some stock selection issues. Particularly, we had automobile stocks, and the big automobile companies were in some sort of price war, or indicated that they will go after market share, and the markets were worried that you will probably see a price war between the large two-wheeler players, and therefore it did not favor the two-wheeler companies, and we had the two-wheeler companies in our portfolio. So partly due to the automobile companies, we underperformed, and then it was also a situation where Reliance did well. And as you know that we don't own Reliance, so a combination of Reliance doing well, our automobile stocks not doing so well, plus we had some cash in the earlier period where, as I said, when the markets went up by 30%, we sold and we held cash. All of this led to underperformance between Feb 2018 till August 2018. Post ILFS crisis, the markets declined. Our portfolio, being a value portfolio, declined less, and that is what it was supposed to perform, and it was in line with the performance, expected performance. Go to the next slide. From October 2018, the next big event was July 2019, when Modi the second time won the elections and the budget was announced. So that was a period when I wouldn't say it was an unusually a very strong bull market. It was a bull market, and we should have normally been able to outperform, but we underperformed. And that was really a period where we had some problems in the portfolio. The entire 2019, and part of it explained in this slide, was a situation where we had stocks in the financial sector which did not do well, and we also had a lot of PSUs, where the overhang of government holdings in those PSUs also resulted in our underperformance. The second thing which really happened in 2019 was also clearly the market favored less risky stocks. It really favored the top class names. So for instance, if you look at the financial space, what was considered expensive at the start of the year became even more expensive. Most of them, which we would generally consider expensive, in a risk-averse situation, they became even more expensive. And world over, if you really look at asset management companies where they have a strong retail business, it tends to quote around 4 or 5%. Even if it's a high-growing economy, you could look at 6%. But 15% and 17% was just beyond us, and not holding some of those expensive stocks also hurt our performance in 2019. The next big event in 2019 was the tax cut. So from July to September, markets declined, and we also declined. We should have declined less, but as I said, we had some problematic stocks in the financial sector which did not do well. Plus, we had PSUs, and therefore our performance at that time was in line with the index. Go to the next slide, please. Post the tax cut, the markets moved up very rapidly. We should have again outperformed, but because 30% of our portfolio had IT stocks, pharmaceutical stocks, utilities, and some cash, and those were really not a big beneficiary of the tax cut. So the bounce back which happened post the tax cut in September 2019 did not favor all our stocks. So while we went up by 8%, the markets really shot up to close to 15-16% because they did not have the same kind of exposure which we had. Subsequent to January, along with the COVID, we have declined in line with the market. I would say in the initial phase, my guess is our performance is actually in line with what we would normally do. And the reason for that is when there is an immediate sell-off, where there is a new risk comes up and people want to sell off, it is usually the liquid stocks which get sold off. Because you cannot really sell the small cap or the mid cap. And so if you want to redeem, if a foreigner in India has a redemption pressure and he wants to sell off, they would usually sell the kind of stocks which we own. So in a very risky situation where there is a knee-jerk reaction, the initial phase we will be in line. We will also suffer. But later on, after the redemption stops, then we will start to do well. And I think that is what has happened now between January 2020 to March 2020, where our decline was in line with the market. Go on to the next slide. As we spoke about 2019, and I said that we had this difficult situation of PSU stocks, which was value, which had high dividend yield. The only thing was the overhang of the government-owned stake, and we had certain financial stocks which did not do well. But if you look at calendar year 2019, it was very few stocks which drove the market. BSE 200 was up by 571 points. Close to 397 was accounted by a few stocks. 70% of the contribution was by these stocks. And if you were to look at only the positive contributors, even then that number is high. I think it is close to around 45%. So it was a very concentrated market, a few stocks driving it. And if you are not in them, you will underperform. You will underperform probably the benchmark, and you may also underperform some of the peers. Go to the next slide. The bounce back from March 23rd from the lows, while it has not been as concentrated as in 2019, nevertheless, close to 40%, 36% is just accounted by these four stocks. How sometimes in a certain short period, because the markets tend to move up only by a few stocks, and if you are not in those few stocks, you may have an underperformance in that short period. Go to the next slide. So that's the background. So that's the external environment, which, as I said, was tough for a value person with no earnings growth and high PE ratios. It was tough. But could we have done something internally? Did we introspect? Did we go back and recheck our processes? Definitely we did. So let me share with you what we have done and how it could help us in future. Go to the next slide. So as I said earlier, our stock selection was in consumer discretionary, and that did not do so well. The large weight in automobile stocks hurt us. The allocations to financial stocks haven't yet played out. While one stock was a problem which we sold off at the start of around March of this year, the other stocks we will have to wait for it to perform. And we feel confident in those stocks that I think the performance will come back. Allocation to public sector undertakings, despite great value and attractive valuations and dividend yield, we will definitely be cognizant of the holdings. And if the holdings are very large, we will be careful in terms of investing, and we may not invest, or we will invest a very small proportion in such companies. Go to the next slide. So our objective in terms of portfolio construction continues to be look at companies which don't have solvency issues, where the balance sheets are strong, and almost all our portfolios are that type of companies, or they are owned by founders who can fund or who can run the businesses even if their balance sheet is a little weak. From a construction point of view, we said if there are balance sheet issues, we will exit the stock, or if the price falls by more than 40% from our original stock price. So what we do is, if after we buy a stock, if it is down by 20%, then we have something called a 3-star review, where 2 fund managers and the research analyst, we will go and meet the company, we will reassess, we will look at our assumptions. And if the stock price has declined only due to macroeconomic issues, then we may continue to hold, we may add if we see some catalyst, or we may even trim a little. But if it's a company specific issue which comes up and that is related to the balance sheet, then we will want to exit. If the company has given us a plan as to how they will address it, then we will give them some time, but it will also be subject to the fact that we don't want further erosion in the stock price. So after we have met, after the company says what are they going to do with the balance sheet and how they are going to address, if the stock declines further by 25%, which means from the original price, if it declines by 40%, then we will exit the stocks. We will not wait till the issue is resolved. However, if the stock has not fallen and we think the company will be able to address its balance sheet issues, then we will continue to hold that. The other change we made was exits. As value managers, as somebody who is process driven, we clearly have an idea as to what is the sell limit on every stock. And the moment it reaches we reassess, we evaluate, and very aggressively sell out. Now what we are doing is we said, let us not aggressively just sell out, do it gradually, so that we have a chance to reassess, to see what else is happening in the company. So while we will sell, if a company hits our sell limit, but we will be careful and calibrate it over a period of time rather than just sell off at one time. From a research process, we have done and we continue to do what we call a deviation analysis. A stock price may move up due to two reasons: a, move up or down; a, our assessments of the numbers could be wrong, or there could be a change in the multiples. So when we looked at our research process and we looked at our forecasted numbers, most of the time our deviations have not been significant. Barring any one-off events or any consolidation or any takeover related issues, if we had estimate X amount for a company, it would normally be X plus 5 or minus 5%. So we have not really gone totally wrong on estimates. But multiples are a different issue. If we would have said that we would like to buy at 2 times or we would like to sell at 5 times, we have seen the market multiples have been completely beyond what a true value manager would like to buy or sell at. So we continue to focus on our research. We want our numbers and our understanding of the business to be good. The market multiples, they go in cycles. Right now, with interest rates being low, maybe the multiples are high, but over a long period of times, they will come back to some normalcy. We will relook at our weights, which we have already done in terms of adjustment on the slowing consumption because of the COVID related issue. And of course, on the PSUs, as I indicated, we will be extremely careful whenever we bring a new PSU stock to see that the stock overhang is not very, very high. So these are some of the changes which we made, both on the portfolio construction as well as on the research process, based on our understanding as to how our performance has been. So as we wrote in our email, 2019 was definitely disappointing, but a lot of learning, and we have put certain things in place, and we should therefore feel confident going forward. So on the next slide, if you look at the future outlook, we did a stress testing of all our stocks in the portfolio. And as I indicated, most of our stocks have very good balance sheets. They generate a lot of cash. The couple of them where the debt levels are high, so we are not really worried so much about that, although we continuously monitor that. So we did a stress test analysis and we feel comfortable with the stocks which we hold. We were able to buy into certain high quality names in the month of March, were really not available to us earlier at reasonable valuations. We were able to do that in the month of March. So based on these high quality names, we expect the portfolio to emerge stronger in the post-COVID world. And because the valuations looked attractive in March, we went fully ahead and bought into that, and our cash levels reduced. This month, the cash levels have gone up because we were trying to recalibrate our weights in the consumption space. So we are confident that the outlook will be good. FY21 would be difficult, but after that, I think things should move up, as Ajit had also indicated in his presentation. Go on to the next slide. So if you look over here, clearly the last 1 year, largely because of 2019, our performance was down by 23%, impacted by PSU and financials, while fund of funds has done well. So the idea is, as indicated earlier, value style, there could be periods when there will be underperformance, and value is not really defined very clearly also by SEBI. So when you look at peer comparisons, sometimes we can see that the characteristics of value is not found in certain funds. So we underperformed. That hurt us. My own money, as with Ajit, we have a lot of my own personal savings is in Quantum Long-Term Value Fund. It hurt. But at the same time, when I look at a combination where we look at fund of funds, which gives you an exposure to other styles, other market capitalization, we can have a few mid-cap funds over there, different styles like growth style over there. And if you have a combination of both, then the return numbers are also pretty good. An 80-20 strategy, as you can see over the last 10 years and even since inception, the numbers are pretty good compared to just being in one kind of fund. So therefore, if you are trying to allocate within equity, please do look at this combination. of both, and don't have all your money only in value. As I said, there could be periods when value will underperform, but a combination will help you address that. Go on to the next slide. So coming back on that blend of QLTEF plus QFOF, that should give you the kind of equity exposure you need, and should also reduce the risk of being only invested in quantum long-term value fund or any value fund. If you have a combination, in our case, we are saying a combination of quantum long-term value fund and the fund of funds, then the blended returns are also quite good. Diversify across asset classes. Equity funds for growth, liquid for safety and liquidity, and gold clearly as a diversifier. Go on to the next slide. Right, these are our returns on the fund of funds. These are available on our website, and you can clearly see how the funds have performed.
Thank you, Subbu. We now recognize that a combination of high PE, flat earnings, and strong flows resulted in a lack of value opportunities for the fund over the last 1 year. The market rally being driven by select stocks and an increased stock supply of PSU stocks by government to meet its fiscal constraints were other reasons why the fund underperformed. Nevertheless, the team at Quantum has analyzed and reviewed the process, of course, staying true to its core philosophy of value investing, and is confident about the future outlook, not only of its existing cash-rich portfolio stocks, but also finding quality stocks at attractive valuations now, thanks to the COVID-19 induced market correction. So thank you, Subbu, again. It's time now to take some questions. Thank you to all the participants for contributing questions. This question is for Atul. Is there a case for equity investing when average equity mutual funds return is less than 10% in the last 10 years, and majority of Nifty returns is just because of 3 stocks? Value strategy has not worked either in a falling or rising market. Can you explain if we should remain invested in the quantum long-term equity value fund?
Yeah, thanks for the question. So, I mean, as it is, it was presented before that it is just about 3-4 stocks that have led to the gain of the entire benchmark. And the reason why this happened was largely 2018 ILFS crisis. And because of that, the risk aversion in the market that increased a lot. When we were buying stocks, we were buying them. The stocks had become very, very cheap, many of them which we had bought at that point of time. And we had thought that at some point of time, there is going to be a mean reversion, and those stocks are going to get reflected from, let us say, what was trading at 0.5 times price to book could come to about 1 time price to book. But in that kind of a scenario, what really played out was that as was explained earlier by Subbu, that the expensive stocks were becoming even more expensive. The stocks which were cheap, even the 0.5 times price to book stock fell even lower to become a 0.25 times kind of a price to book. So we believe that, and the companies that we own, many of them, they are still kind of franchises which have been good businesses. They have existed for very, very long period of time. They have seen multiple cycles, and hopefully they should be able to do well. So we remain confident about the value because these stocks are giving you stability in this thing, but then there can be cycles. And from over a period of time, we have seen that there have been a number of kind of phases in my own experiences, the markets, right from the period of 99 2000 was where people were chasing eyeballs, buying internet stocks. That was when value was not doing well. The period after that, 2003-4, when shopping malls came up, from the story changed from eyeballs to footfalls in terms of the mall stocks. Then it was in 2006-7 a period, it was about capex boom and all the capital goods stocks which were there. So there will be phases which will be there, and in certain phases, obviously, the particular style may not work, but we believe that over a longer period of time, over the cycle, this should work.
Okay, thank you, Atul. The next question is for you, Subbu. Why has the Quantum Long-Term Equity Value Fund not beaten the 7-year benchmark? How long is long-term for Quantum? Please explain.
So, see, there's no fit definition as to how long is long term. But generally, in the equities, we say at least you should have a 3-5 year time frame. Now, in this case, yes, we underperformed over the 7 years. But I think Atul had explained a large part of that underperformance also comes from the fact that the last 1 year we had terrible returns. So you have to understand that there could be these big swings sometimes which can hurt the long-term performance. We have to take care, and that is what our process is trying to do right now, that we don't have such wild swings, which either on the downside or on the even on the upside, which is not very explainable as a value investor. So had that 1 year return not been so bad, the numbers could have been a lot more different. The second is, that while I don't want to defend, but nevertheless, just for a statement of fact, we have a style. We are a value managers with certain characteristics in terms of price to earnings, price to book. The index is not a value index, right? It is called the BSE Tri or BSE 200 index, which is not a value index. There are a lot of growth stocks in them as well. So sometimes if the market for a long period of time favors only growth stocks, then also we could underperform. So for instance, if you look at our price to earnings ratio, I think it would be around, for the portfolio, it is around 9 times or just below 10. While for the index, it is more closer to 16 times, 17 times price to earnings on a forward looking basis. So the index is not a value index, but I'm benchmarking against that. And as we said, the process changes which we bought should probably help us going forward to beat the index. And we have done it in the past in a normal, sensible market where it doesn't move just based on few stocks. We have beaten the index. So if that kind of situation arises, I think we will definitely should be able to beat it. But to give you a rationale for the historical reason, as I said, it's not a value benchmark. It's a benchmark which has a lot of growth stocks, and there could be periods when we may underperform.
Thank you, Subbu.
Ghazal, can I just sort
Yes,
of
sure.
respond to something that may have been unsaid in what I was saying that's come up on the chat? So please recognize I'm not telling you that I don't like the value fund and therefore you must put your money in equity fund of funds. Look, we all have different religions and there's one God, and we all have different paths to that one God, right? Similarly, in stock markets, there are different ways of investing. There is the index fund, there's technicals, there's fundamentals, there's different. I prefer and I like the value approach. That is my path to my God. That's my path to my nirvana. But and I understand that I've done that for decades. But someone who's not in the market every day, who said, look, I have a business, I have a job, I've got retirement money, and I want to keep money in investments in the stock market, and I want to earn a good rate of return better than an FD. For that person, I would say, why are you taking a style bet? Why are you worried whether value is working or growth is working or the index is working? I don't think the index will work right now, but to take that as an example, right? Which is why index funds gain popularity. People just said they'll buy one check, and as Subbu just said, the index fund has a lot of stuff in it. Whereas what we've done is we've given you the value fund, saying this is our style, this is our God, it's our path to nirvana. And these are other people with other religions, they have other philosophies, they have other paths to God, and we put that in a nice basket, and we've given you in some sense universal world religion. Just put 20 in the long-term value fund or 10 or whatever you want, and 80 or 90 in the equity fund of funds, and you're fine. Please do not construe my words as lack of faith in the value fund. All I'm trying to tell you is that as someone who's not involved in the market on a day-to-day basis, why should you come to my religion? Just put your money in a basket, and as long as you get your rate of return, you'll be happy. That's why we're showing that chart of 20-80 mix or 80-20 mix between equity fund of fund and value fund. Please do not take this as a view. And again, that's the other point, is that if you have got the value fund and you've got other mutual funds, then you're fine. They may not be the equity fund of fund. Your basket will work for you. At some point in time, value will do very well. Some point in time, small cap will do very well. Some point in time, small cap will collapse and value will do better. Just leave it in a basket. Either you design the basket or Quantum Equity Fund of Funds has designed that basket for you. That's your choice. That's your call. That's your choice in some sense. Yeah. Thank you.
Thank you, Ajit. There's another question for you. There is no medical solution yet, and it may take many months to get one. MD of Morgan Stanley on CNBC has stated that we are looking at a global recession in 2021. So are we looking at another fall in the market? Has the market yet to discount this global recession?
So, as I showed in one of the slides, and maybe Kashif, if you're there, you can go back to, I think it was slide number 6 or slide number 7 or 8 with the PE ratio. Sorry, I'll tell you which slide it was. Page number 9. Sorry, page number 9 on my book. So if you look at that P ratio slide, again, I go back, it indicates that in the time of stress of SARS 2003, of the Lehman crisis of 2008-9, you saw what stock markets did around the world and they collapsed. So is it possible that this is the bottom? It may not, it could not be the bottom. I don't think it's a bottom. I think it will go down even further. A lot of it depends. So we had those big V-shaped recovery after Lehman. The recovery was the response. The response was the central banks in the world saying, the bank's open, we're just going to print money and they're going to rescue you. Well, the banks can keep on rescuing for a while, but the government in this crisis has to step up to the plate and they have to do something. And the government has to send money to the poor people, to the migrants. They have, in my view, they've got to send 10,000 rupees per month for 3 to 6 months to 100 million households, if not 150 million households. And unless you commit 2 to 4 months of GDP, 2 to 4% of GDP on fixing the bottom of the pyramid problem, we'll go in for a long, long, long problem. This will go on for a long time. So the world and the US stock markets, for example, are rebounding because governments around the world have stepped up to the plate. In Australia, the government has guaranteed 80% of your salary. They're spending 15% of GDP on a rescue plan. In the US, it's about 10%. Germany is also in the rescue. Germany is also telling airlines like Lufthansa, we will rescue you. Here's a check, but the condition is it's linked to ESG. It's linked to you, Lufthansa. When you take the money from us, you need to make sure that all the bad planes, the planes which are old, which emit horrible carbon, they should be removed from your fleet. They're putting conditions on it. So like I said, Germany, there's a rescue. India, there's free money being given to rescue the mutual funds without any penalty to them. And a lot depends on the government response. Right now, the people who are being penalized are the migrant workers who've come to cities, whether they are abais, whether they are cooks, whether construction sites, they are the ones who are suffering the most. And there's no rescue plan for them. They're just kind of left literally stranded on the street. That's a problem. That's a social problem. That's an economic problem. So it's a huge problem, which we hope in the next hour or so, our Prime Minister actually addresses. I mean, how many times can you keep on banging thalis and lighting diyas and having jet planes fly? It's time to announce something on TV and then follow up with some actual hard numbers. So if you do not have a rescue of the Indian GDP, yes, you could have a bad recession in India for a long, long time, and then the markets will reflect that. The markets could come down if there is no recovery in GDP. So a lot depends on what happens in the next few minutes when we hear our Prime Minister speak on national TV and announce, hopefully, a plan.
All right. Thank you, Ajit. The next question is for you, Atul. Why is Quantum holding so many PSU stocks which have underperformed for the past 5 to 7 years?
Yes, so many of the PSU stocks, they have not done well. One of the reasons was that some of them they have kind of supply coming, in the sense that government, to meet its financing requirements, that has in terms of FPOs, etc., or new fund launches, ETFs which are being done by government for PSUs. So that is one set of problem which has been there for some of them. Maybe a few of them could have specific problems. For example, in the case of ONGC, it has been the fall in the oil prices, and oil prices corrected to about $20. Obviously, now they have recovered to about $30 thereabout. We believe that some of these, oil price, could be a short-term phenomena, and given where the costing, etc., many of those things remain, so they would be relatively they would certainly go higher over a period of time. In many of the others, for example, the other big set that we would be holding would be some of the utility stocks, and maybe other on the one stock on the banking side, which is SBI. So there again, in the case of many of the utilities, again we find that the valuations are very, very reasonable, and given the very predictable business models, assured ROEs, as well as not much problems on the ROE and receivable side, they are not challenged onto that side. They should also be doing well. But obviously, right now the markets are not pricing, and because of some of the overhang on the how the state electricity boards, that is carrying on to some of them. So I mean, obviously, we would say that in many of the cases that they are priced relatively low. They have a good kind of a case for some of them, and it's much more to do with the recent government supply that has created kind of a overhang on many of those stocks. From our side, obviously, we are looking at. I mean, we are on a regular basis monitoring all those stocks. We always kind of discuss them. Is the case changing? In few of the cases, very recently, we have also trimmed the position because we were seeing the risks to be higher. So we are constantly reevaluating, and we believe that in many of the cases, the supply overhang may go because government is kind of reaching a position which is closer to about 50-51%. And at that point of time, beyond that, maybe there is less scope of government selling onto those stocks.
So if I can just sort of jump in on the PSU stocks, one of the there's a query that's also there on the chat group, is the difference between a value stock and a cheap stock, and that's called the value trap, and someone's written about that on the chat group, and that's a very good comment. So a cheap stock is something which is inexpensive and will always remain inexpensive, and you're kind of stuck in it. It's what they call a trap, a value trap. Whereas a value stock, as we've defined it, as we've learned over the last few decades from our experience of investing around the world and in India, has been that the stock is inexpensive and has a catalyst for a re-rating. And we typically look for a catalyst over 2 to 3 years. That's what we do in our process. Some people may wait for 10 years, some may wait for 6 months. We look at it for 2-3 years because policy making in India tends to be that slow and that frame of mind. So, and a lot of that analysis is what we do in the research process.
Thank you. Moving on to the next question, Fatul. What is your opinion on multi-cap funds?
Yeah, on the multi-cap fund. So, I mean, obviously, from an investor perspective, what is offered even in quantum equity fund of funds. So that is good, especially to have multi-cap funds which have a higher proportion of maybe on the large cap funds, maybe smaller of the small cap and mid cap kind of this thing. So because when you have a large cap fund, that gives you a stability, and a small cap or a mid cap fund, obviously that gives you growth, but also make sure that when markets are falling, the large cap proportion still kind of protects the overall fund from that perspective. So maybe a multi cap with a higher proportion on the large cap, smaller proportion of the mid cap, small caps, that should do well. But then investors always have to be aware of the proportion, because we have seen in many of the crises, especially the earlier periods when mid caps were doing very well, small caps were doing very well. The allocation was just the reverse, that they had a larger allocation to maybe the mid cap and small cap, and lesser to the large cap. So in that kind of a scenario, when the market corrects, then there can be a lot of wealth destruction that can happen.
Thanks,
Ghazal, can I just sort of jump
yes,
into some chat questions that are here on expense ratios? So a lot of people are telling us, hey, you're not doing so well. Why don't you bring your expenses down? You know, we charge a fee. We've been very transparent from day one about what we're charging. And I think a couple of years ago, we actually announced a scale that as AUM grows, what the expense ratio will be. I think we were the first fund house to do that, probably the only fund house to do that. We went through every scheme that we have, every product, and we announced the AUM, and we said, this is what the expense ratio is going to be. So we've done that. As AUM grows, you know, our marginal cost of servicing or managing the next 100 crores that you put in is not the same as the first 100 crores, right? So we keep on reducing that, and we will be doing that. But to reduce expense ratios now, that's, you know, I mean, we have to figure out how do we not lose 900 basis points or 9% against an index or a benchmark or the peer group, versus trying to figure out, can we save you 0.1% or 0.2% in expense? That's the bigger problem. You know, you should redeem out of quantum if we can, a long-term value fund, if we cannot fix the problem, rather than saying, Ajit, you're not being fair to us, and maybe you should tell the board and the management to cut the ratio, expense rate 0.1. That's not going to do it. 0.1% is not going to move the needle. It's not going to move the needle at all. Regaining value, showing that we're good at our work, showing that we have the competence, proving that to you, that's what's going to actually make the difference, in my opinion. But you know, but thank you for that suggestion on the chat group. That's very nice of you.
Thank you, Ajit. Now we have only about 10 minutes left, so I'm going to leave the floor open to the speakers. If they have any concluding statements or would like to take any questions from the chat group, please feel free to address that.
You know, so there have been a couple of questions about COVID-19 and, you know, in the world and markets. So again, going back to that. So, you know, I have a very different view on COVID. I was in London on March 5th, 6th, marketing, raising money. And I saw around me that in London, people didn't seem to care. And I have an underlying condition of asthma. So I was a little nervous about my health. So I said, I better get out of London. And I went to Zurich, where my son goes to school here. He lives here with his mother. So I said, okay, I'll come and, you know, be with him for a while. I came here and I found this to be worse, because Switzerland sits on the top of northern Italy, and northern Italy had already exploded by then. And in 5 hours, you can take a train from Milan, northern Italy, and land up in Zurich station. 5 hours, and you can bring all the virus with you. So I got even more scared, and I came to India on March 8th night. It was a night of Sunday, and by then India had just announced screening at the airport, right? So I got on the line of the screening. I thought they're going to do a big test and all. And there was a person out there with a gun, you know, with a thermo gun, checking my temperature. And then, you know, we were let loose. And now one of the characteristics of the virus is that you could have it and you could not have any fever or temperature, no symptoms. So I don't know how useful that screening was. To me, it was useless. So I got home on March 8th night, late night, and I had to meet Subbu and all the next day night. I told Subbu, I'm self-quarantined. I'm not going out of the house anymore. I'm just sitting in my room. And in my own apartment, I sat in my room. I didn't go out to the living room or the dining room. I requested my cook to send all the food to my room. And I stayed there for 2 weeks. And, you know, Quantum shut down on March 12th. We had a lockdown, right? March 12th, we began working from home. So we discussed it and said this COVID thing could be worse. March 12th, we said, let's all work from home. So although the official lockdown was the 24th March midnight, already for 12 days we were working from home, and whatever was going right or wrong with us with our software, Kashif is somewhere in the background. He and his IT team did a fantastic job, ensured that all 280 plus people in Quantum could work from home without a problem. So we did that. And then we had, waiting for the government to do things, which they started talking about COVID, and they realized it was bad and they had the lockdown. And I wrote an honest truth saying, I support the lockdown and it's something that the Prime Minister did and it was necessary, because we all read about this flattening the curve. And while we were in lockdown from 25th March, early morning, midnight, whatever morning, till April 14th, the first 3 weeks, the government should have prepared itself a lot better to build, for example, hospitals and whatever else. I know that in the city of Bombay, and I've written a bit about this, in the city of Bombay, the BMC had announced a 2 crore rupee budget to fight COVID, 2 crores. And on the same day, they'd announced an extra, I think it was 1,200 crores to spend on the coastal road. So they're spending about 4 to 5 crores a day on the coastal road. And while we've been in lockdown, the coastal road work is still going on. Even today, as I speak, in the night, they're dumping rocks or doing what they're doing. And only in the last few days have we been seeing images of the BMC trying to now take over the Mahalakshmi race course and other places, open spaces to build hospitals and beds. So the government, whether local Bombay specifically, and the government at the national level, has completely failed us. They have not used the lockdown period that we had to plan and strategize the hospital beds that they need. And I'll come to that in a second. You'll all use Worldometer, right? I have it on my phone and I can look at the stats right now. And the Worldometer is amazing. If you have it, please look at it while I'm talking. And it'll tell you stats, and the stats are shocking. It's so, as per what I'm seeing right now, there are 4.3 million cases in the world. Of the 4.3 million cases, 288,000 of them are dead. They're no longer alive. That's a problem, obviously. But if I look at another stat, that means that of the another 1.5 million recovered, right? So 4.3 million had it, say 0.3 million for argument's sake, 300,000 died, and 1.5 million recovered. So what that means is there's still another 2.4 million people who still have it. Now look at that number. I'll try to show it on the screen if I can, if it shows up. The 2.4 million people who have it, only 2% are classified as serious or critical, 2%. In the first number of the deaths, which is quite shocking, in the first number of those who died, look at that number, it's 16%, right? Of the known cases, those who recovered and those who died. 16% of the first 1.8 million have died, and only 2% of the next 2.4 million are serious or critical. What does that tell you? And this is after me speaking to a bunch of people in the medical field, and there are different opinions on this. It tells me at least that there was a huge surge in hospitals and beds and medical facilities, and they could not handle it. So people died because there's no one to look after them. Once you flatten the curve, obviously now with less people coming per day to the hospital, the deaths have reduced dramatically. Not the deaths, the serious, the critical, it's 2%. Of these 2%, probably 20%, 25% may not make it. So the death rate may be only 0.4 or 0.5%, as opposed to 16% for the first batch when everything was opened up at a rush. Therefore, rather than building coastal roads, rather than trying to rebuild this whole vista in Delhi and to redo parliament, why can't our government have spent the last 2 months that everyone's been locked down? Why could they not build more hospital beds? That's what they should have done first. Because obviously the answer is, the more time you get with the patient, the more chance of them coming to hospital to see you, the less chance of them dying. And to me, this whole debate about the lockdown has gone berserk. I mean, we're crazy that people like me who have an underlying condition, I need to be careful. Now, to save me, why should 99 people not go to work? Or why should 99 people not be allowed to go out? I mean, to me, the whole equation is completely mad. And on top of that, okay, fine, if you tell me lockdown, then you pay my bills. If you can't pay my bills and you don't let me to go to work, just to save one person out of 100, to me, the equation is completely rubbish. So let's hope in the next few minutes, when we hear our Prime Minister talk, that we are a bit more sensible and a bit more pragmatic as we weigh the human cost of the COVID crisis in terms of getting ill, and we weigh the human cost of seeing the impact of society by keeping everyone locked in and not doing anything to help them better their lives, particularly the migrant workers and the poor people, and small businesses and big companies, etc., etc. So these are all, and oh yeah, thank you, Kash, you got that on the screen. So these are all to me like very, very important things that are not being put out there in the front. And every day we see on our TV, there's fear. We're being sold fear. The COVID virus, not me, this is world data. It doesn't look so dangerous to me. It's dangerous to me because of my health, my underlying condition, but not for most people. I mean, Ghazal and Subbu and Atul and all of you all will all be fine. So I don't understand what we're doing. This gone insane in my view. It's really gone insane. Sorry, I've gone off topic a bit, but just it's been something that's been brewing in me, and I'm pretty upset about it.
Thank you, Ajit, for sharing those insights with us. I think we're running out of time now, so we'll be wrapping up the session. But thank you everyone for attending. Thank you to our speakers. We hope you found the session to be informative and we answered all your queries. We will be coming back with more such sessions very soon, so stay tuned, and closing the session now.
Thank you.
Thank you, Ghazal. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.